The secret with beating a director penalty notice, if you're going to, is always in the details. When you do ring up the tax office to do that, you're calling up the deadline, and those people are actually debt collectors. They give you 21 days, where we have successfully beaten a director penalty notice. There are a lot of things that you don't want to get in the mail, and a director penalty notice is one of them. Can you imagine? You're just sitting there, you decide to check your mailbox, maybe you're coming home from work, see an envelope, some bills in there as well. You open it up, it's a director penalty notice. Think, what do I do with this? You might Google it, you might contact your accountant, you look it up, it looks like maybe some scary stuff, maybe the number's very big. Now what this video is about is how you can beat a director penalty notice. Now there's a lot of material out there about going into liquidation and doing all these other things, restructuring debts and so on. That doesn't have to be the only way. It might not be the only way. And so in this video, we're going to go through 2 case studies from clients where we have successfully beaten a director penalty notice. And I'll go through and explain how that occurred. Now, the 2 scenarios, so you know, are the first one was a client who had PAYG and GST debt and then was sued by the tax office in the district court with a statement of claim. The second one is someone who had liquidated their company, the company's shut down, and then received a director penalty notice for superannuation. Okay, now just so this doesn't turn out to be a very long video, what I'll probably do is I'll do the first case study in this video, and then I'll do the second case study about the superannuation in the next video. So before I get started and go into the case study, launch right into it, let me explain how the system works, because without understanding that, it's very difficult to work out what to do. Those director penalty notices don't give you a lot of information. They just say, here's a series of numbers, this is how much you owe, and something about how you have 21 days to either pay the debt or go into liquidation or some sort of administration or something like that. Now, when you get those, what a lot of people do is they ring up the tax office and they immediately try to negotiate a payment plan or something like that. And they think that doing that is good enough because they've sort of agreed to pay it or whatever. It doesn't quite work that way. And when you do ring up the tax office to do that, you're calling up the deadline, and those people are actually debt collectors. And debt collectors are professional people whose job is to collect debts and collect it as fast as they can and as much of it as they can. So they're obviously not really there to kind of help you out as such, other than to help you out paying, if that's what you're looking to do. So anyway, let's start with how these rules work, okay? So firstly, it applies to directors. So for that to be the case, you have to have a company, okay? And you need to be the director of that company, okay? If you're a sole trader, obviously it's not relevant to you, okay? Then the company, needs to have a tax debt. It needs to have a GST debt, a PAYG, which is for employees, or superannuation debt. It needs one of those 3 debts, okay? And then the company has to have not paid those debts, okay? Not paid it. So it has an amount owing, okay? Now, the way the law works is that if you are a director of a company, you are actually liable for the PAYG, GST, and superannuation if it's not paid on time. You're personally liable. And what does that mean? What it means is that usually a company has its debt and you personally have your own debts. The company might owe a supplier money, you might have a mortgage, and you might owe the bank money, but you're separate, okay? So if the company has a PAYG or GST or superannuation debt, that belongs to the company. Now, when you're personally liable, it means that if the company owes that money, if the company doesn't pay, you need to pay. That's basically what it means. That's personal liability. And so everybody actually who's a director is personally liable from the get-go, basically. And what the legislation says is that you're personally liable until the debt is paid off or you do some sort of restructuring event, like a liquidation or small business restructure or administration or something like that. Okay. And that's just a continuous thing that's occurring. Okay. And then what happens is, for that liability to be actually collected. So you're personally liable already from the get-go. For the liability to be collected, the tax office has to issue you a director penalty notice first. And what that does is it puts an end date on the time that you have to pay the debt off or to enter administration or restructuring or something like that. Okay, and it gives you 21 days. So you've had sort of an indefinite period, but once that notice is issued, it cuts off that period, and you've got 21 days from the date of the notice to do something. And then after that time, the tax office is free to collect from you personally. Before that date, you were personally liable, but the tax office can't collect the money from you. Now, they've issued you the director penalty notice, and they can collect the money from you. Okay? Now, they don't have to collect the money from you, and often they don't collect it straight away, but it means that they can at any time. So in the case study I'm going to talk about, the director penalty notice was issued in 2021, but they didn't sue the client until 2024. Okay? So 3-year period. So you can be waiting for a while, it just sits there. And then when you, if you ever apply for a loan or finance and they ask for your tax portal and debt, it'll show up on there as a liability. Now, with director penalty notices, there's a difference between what's called a lockdown and a non-lockdown DPN, director penalty notice. The difference is basically this. If you lodge your activity statement or whatever it is too late, there's a certain time period, a certain grace period for those, or sometimes, for every tax it's a bit different. Then you're personally liable regardless of what you do. So using the example of if you put the company into, say, administration or do a restructuring, in that situation, you are personally liable regardless of if you do that because you lodged too late. But if you lodge on time, it means that you lose that personal liability, okay? And you're not personally liable anymore if you do the restructuring. So it really hits at that. It's really punishing people who lodge late, basically. And that's the difference between lockdown and not lockdown. So the situation for an individual is much more limited when you've got a lockdown situation. Okay, so let's go into this case study and I'll tell you what happened here. Okay, so the client received a director penalty notice in 2021 and then they got sued by the tax office in the district court for debt recovery in 2024. The first thing we noticed was we looked at the statement of claim and it looked cookie cutter. Now, when the tax office issues these director penalty notices, statement of claims, and so on, it's on a mass production basis a lot of the time, and they're just seeing what will happen. It's a tactic that's used by a lot of debt collectors, actually, not just the tax office, but even private ones, to just file and see what happens. And so they filed. We had a look at the statement of claim, and I thought, this does not look like it covers specific facts because it doesn't. The secret with beating a director penalty notice, if you're going to, is always in the details, because the tax office does them en masse and it's a broad brush type of situation, but it doesn't take into account the personal situation of any one individual. And so those details matter, and those details are the difference between being successful and not successful. So when you look at the statement of claim, I looked at it and I thought, look, they're not familiar with any details. In fact, there were some paragraphs missing. It just looked like it was clunkily put together in a rush, like just from a template or something, and just filed. And I thought, it doesn't look like they've taken into account all the details here. Okay, so that's your clue. When you get a generic thing like that, that's your clue. So the appropriate way of responding to it is to file a defense and to say, okay, when you look through the actual detail and the provisions and all the requirements and how it actually works, we have a valid defense here. Here it is. We filed it and handed it in. Okay. Now, as is often very common with the tax office, they tend to say straight up, look, I don't think you've got a case. Most people do that actually when you're running court cases. No one ever says, hey, you've got a fantastic case here. Most people say, you don't have one, or it's weak, or something like that. But the more important thing that happened here is they allocate a human being to it. Before that, there's no person you can call or anything like that. And the person says to us, look, your defense isn't very good, so on and so forth, gives us all these reasons why. But it was obvious to me that they were not familiar with all the details either. So we spoke to them, went through these details, and I said, look, I just, when you look through these details and here it is, here's some info which they hadn't considered before or looked at or were not even aware of, it looks like, your case is not going to make it. So they said, look, leave it with us. And they took that away and they came back and with an offer. And that offer was, we've decided to discontinue the case. And everyone can walk away. So we'll just cancel the court case. Now, I said, hang on a second, hang on. You didn't have a case and you brought a case and now my clients incurred legal fees. So someone has to cover that. Normally when you withdraw a court case, if you've done one, you need to pay the other side's legal fees. And so we pushed back and said, look, you've got to pay our legal fees, and the tax office agreed to pay our legal fees. So what happened was, it was a fantastic result in the end. And that's the risk that you take with the cookie cutter approach, is that you're going to get people who your claim is actually not very good against that particular person. You're going to lose, you're going to end up paying costs. They tried it on first by trying not to get costs, but they end up having to pay. And that's a tactic. They might get out of 10 people, 9 people might just give up straight away without even trying. And then there might be the one person that this happens to, and overall they're up. And that's the debt collection cycle mentality in the same in the private sector. We were able to get the case dropped and we were able to get our legal fees as well, which was a fantastic result. So that's, in a nutshell, what happened in that particular case study and sort of how we went about doing it. If you've got any questions or if you've received a DPN or wanting to consider your different options and different strategies, feel free to give us a call. I'm going to do the next video now about the second case study, which is about the superannuation, which was a DPN issued to a client for a company that had already gone into liquidation and was already shut down.